The real inflation was in the early 2000s. For some reason, it didn't get through to the broad-based indicators the way it did to commodity prices. But there is much less inflation now. And now we've got oil prices, the most visible, cracking on us. Here, metals to gold, the purchasing power of gold has continued to go up, as you see in the purple line. So metals relative to gold. When this line is going down, the purchasing power of gold more creative in terms of products and services. And so we have high hopes that when the new leadership shows itself, and typically if we are in a correction or a bear market towards the end is when we see new leadership. I remember very clearly in 08-09, the market did not bottom until March of 09, and our strategies started outperforming in November of 08. This is what typically happens as the market looks to the new leaders.
Consumers are nervous, and that's exactly when the magic begins. When wallets close and uncertainty takes over, innovation doesn't pause, it accelerates. History proves that market corrections don't just clear out the weak, they create space for the next big players. Think back to 2008. While the crash sent shockwaves through the economy, a new generation of market leaders was already rising, months before the official bottom. That same pattern? It's happening again right now. As fear spreads through Main Street, a quiet shift is underway. People are no longer just spending, they're demanding more. Better quality, lower cost, and faster solutions. It's exactly this pressure that drives breakthroughs and resets the playing field. Cathie Wood sees this moment not as a threat, but as a launchpad. She often points to late 2008 when her innovation-based strategies began outperforming, even while the broader market was still falling. Because true leadership emerges before the recovery, not after. Right now, consumers want more for less. Investors are searching for clarity, and beneath the surface, a new wave of disruptors is quietly gaining traction, from AI-driven platforms to next-gen fintech solutions. The question isn't if they'll lead the next cycle, it's who and when. According to Cathie, the next market giants are already in motion, and for those willing to stay patient, spot them early, and ride out the noise, the potential upside could be game-changing. So let's dive into some explosive moments from Cathie Wood's latest interview and see exactly why this moment could define the next decade of investing. Before we jump in, don't forget to like, subscribe, and turn on notifications so you never miss out on this kind of deep dive market content. Thanks for being here. Let's get into the video.
So here, I've seen these charts for years and years and years, but I didn't realize that we had hit from a public debt as a percent of GDP, that we had hit the peak we reached in World War II. In the 2000 timeframe, there was the thought, could we be heading in the tech and telecom bust? Could we be heading towards that level? But here we are. And, that was a crisis time, and the country really did pull together after that to get the debt as a percent of GDP down. It did it in two ways. More control over government spending. Of course, we weren't in the war anymore, so that was a big source. But also on the GDP side, rapid growth. Post-World War II, very rapid growth. Doge, we think, is an attempt to pull us out of a quagmire, it seems, in terms of government spending. It's what held the economy up, or real GDP up, along with high-end consumers during the last few years. But this is certainly excessive as we see it now in context. And you can even see in the 20s, in the 20s and 30s, we didn't get anywhere near this level. Another look at the budget, and you can see total outlays as a percent of GDP, around 24%. Now, what is not clear from this chart, but I do know, having studied this, is that receipts tend to top out in the 17 to 20% range. If the government tries to tax people any higher, they figure out ways around it. They either stop working or they do a lot more under the table. I don't know what it is exactly, but that receipts as a percent of GDP rarely goes above 20%. So this deficit is structural. And I do believe that with DOGE and with more rapid GDP growth, we could move back into the period like the 90s. That was the last time we saw a surplus, and it was under President Bill Clinton and Newt Gingrich, who was a powerhouse in Congress, and they worked together to get that done. We do not have as much of a bipartisan situation right now, so we'll probably have to do more on the rapid GDP growth side of things. And if we're right, if deregulation, tax cuts, lower interest rates are what we're going to see as the government has more degrees of freedom during negative GDP quarters, then I do think we'll see much more rapid growth in the months ahead, months and years ahead, I should say. Onto monetary policy. Here I've presented this a number of times. It does seem like CPI, which is in the green there, is kind of stuck in that 2 to 3% range. Now, there are other measures of inflation out there that are saying something different. There's a measure called Trueflation, and we'll have it for you in the next, I think we're going to subscribe to their service, so we'll have it for you in the next package or in the next In the Know. It is saying that inflation is down to 1.3%. And this is a real-time measure of, I don't know, I used to say millions of products and services, but I think it's more like tens of thousands or thousands, but real-time, constant monitoring. And it peaked at 11% just about the time that the CPI peaked around 9%. It is now down to 1.35%. And as you may also notice, the oil price seems to be under severe pressure because Saudi Arabia is opening the floodgates. Purportedly, it is railing against Kazakhstan and Iraq overproducing and is just opening the spigot. There could be other reasons. Part of the negotiating out there, President Trump, I think, is with Saudi ministers this weekend, maybe even MBS himself. And there may be, and as he's been very vocal about getting oil prices down. So that may be part of what's going on here as well. Of course, the third variable is weakness in the economy. So all of those accumulating, which is going to take that trueflation measure of inflation down even further.
America's debt to GDP ratio has now climbed back to World War II levels, but this time there's no post-war boom on the horizon to save us. Back in the 1990s, we saw surpluses driven by growth and bipartisan cooperation. Today, Partisan gridlock has us clinging to quick fixes, speculative assets like Dogecoin, and hoping tax cuts will magically spark recovery. But inflation keeps sending mixed signals. Oil prices are falling fast, taxpayers are stretched thin, and optimism is in short supply. The hard truth? We're venturing into uncharted economic territory. There's no clear playbook for what comes next. The big question now, can innovation outrun the debt spiral? Or are we doomed to repeat history? Commodities just crashed back to early 2000s levels, while gold is quietly reasserting its strength as a store of value. Treasury yields have dropped below 4%, and a staggering $250 billion in stablecoins is helping to prop up demand in fragile markets. And that's just scratching the surface. Bitcoin is struggling to keep up with gold, yet it's holding steady along its long-term trend. Meanwhile, Saudi Arabia's aggressive oil policy is reshaping global energy dynamics. Add to that the breaking of a 40-year downtrend in yields, and the entire financial map is being redrawn. According to Cathie Wood, we've officially left traditional economics behind. She argues that tech-driven deflation is now the dominant force, and that the rules we've relied on for decades no longer apply. So the question is no longer what's normal, it's what comes next. Let's dive into more from Cathie Wood's powerful interview to explore this shift and what it could mean for investors, consumers, in the future of the global economy.
Now we're on to more market indicators. So Bloomberg's Commodity Price Index, we did this chart earlier this week. I think the Bloomberg Commodity Index has dropped back to 100, and probably will continue to go down if our economy is as weak as we think it is. But as I always like to highlight, the Bloomberg Commodity Price Index is today where it was in the early 2000s, in the early 90s, in the early 80s, which from an inflation concern point of view helps put where we are in perspective. The real inflation was in the early 2000s. For some reason, it didn't get through to the broad-based indicators the way it did to commodity prices. But there is much less inflation now. And now we've got oil prices, the most visible, cracking on us. Here, metals to gold, the purchasing power of gold has continued to go up, as you see in the purple line. So metals relative to gold. When this line is going down, the purchasing power of gold is going up. Gold can purchase more in the way of metals at a given price. Now, this chart doesn't show what has happened today. The 10-year Treasury bond yield did drop below 4%. If we're right on what's going on here, the 10-year Treasury bond yield probably will continue to come down. I know a lot of people speak about China and other countries disgorging our Treasury securities. And from a supply-demand point of view, that is happening, and it is a lack of demand relative to supply showing up. But there is a bit of a flight to safety going on right now, and there's also another phenomenon. I don't know how much it would have an impact on this, but the stablecoin movement, those are backed by Treasury securities. And while they're Treasury bills, I'm sure there are ripple effects throughout the yield curve. So the stablecoins are now up to 250 billion, and we expect them to go to 1.4 trillion in the next 5 years. So we would expect the pressure on interest rates in the near term here, certainly because of the economy, to be down, to go down. Bitcoin to gold. Gold has had a good run against Bitcoin. Bitcoin did very well relative to gold in 23 and 24, but not so this year. Nonetheless, we do think over time Bitcoin will appreciate relative to gold. And as you can see, it has not broken the uptrend line. Here is the S&P price relative to gold. This is an indicator that Charles Gov of GovCal is monitoring, and he would not be surprised to see the S&P fall as it did in the 70s relative to gold. We would be surprised to see that, especially if we're right on all of the productivity and pent-up demand that fiscal and monetary stimulus should unleash during the years ahead, and the productivity gains associated with it. On the other hand, he would have expected this metric to go down as well, but it is not. The S&P is holding up relative to oil. Oil, of course, is capitulating recently, as I mentioned, because of Saudi Arabia's recent decision. And just a few more charts here. 10-year Treasury yield. We did break the downtrend, and that was a 40-year downtrend. Probably in COVID got to too low of a level, and we would not be surprised to be in a range now for the next few years, 2.5% to 5% range perhaps. But if we see more deflation thanks to the new technologies that are evolving, we wouldn't be surprised to see it settle a little lower than 2.5. But clearly the burden of proof is on us on that one.
2008 financial crisis. When consumer confidence falls and wallets tighten, it often sparks the conditions needed for disruptive ideas to emerge, ideas that end up reshaping entire industries. Investors and leaders who recognize these shifts early, like Cathie Wood, understand that true innovation often begins in the darkest moments. Her strategies, for example, began to outperform well before the markets officially bottomed out in 2008, proving that real leadership shows up before the rebound. Fast forward to today, and we're seeing similar patterns unfold. With traditional systems under strain, cryptocurrencies and stablecoins are gaining real traction, offering a fresh way to think about money and value, just as tech disruptors did during previous downturns. Charles Hoskinson, founder of Cardano, has projected that Bitcoin could reach 250,000 this year, fueled by global instability and growing acceptance of crypto in international trade. Even more game-changing? The potential entry of giants like Apple and Amazon into the stablecoin space, once regulation becomes clearer. That could mark a major turning point in finance, where digital assets aren't just speculative, but become everyday tools for consumers and corporations alike. Meanwhile, the U.S. is facing a troubling mix of rising national debt and political gridlock, which is making traditional economic playbooks less effective. But as history has shown, these kinds of downturns often become launchpads for groundbreaking solutions. It's the bold, tech-driven thinkers who tend to lead us out. Right now, the next wave of market leaders is already forming, quietly, steadily, beneath the surface. If this cycle repeats the patterns of the past, we could soon see crypto and technology redefine our understanding of wealth, money, and value itself. So as we wrap up, we want to hear from you. Do you think Bitcoin will eventually replace gold as the ultimate hedge against fiat currency collapse? Drop your thoughts in the comments below, give this video a like, and share it with someone watching the markets closely. And if you haven't already, hit that subscribe button for more in-depth content just like this. Thanks for watching. See you in the next one.